All right, welcome back to the Gray Report. Again, I'm your host, Spencer Gray. Let's get into some of these articles related to the multifamily industry. This is a little bit more macro, but it's right on the headlines. Have to talk about it. And I thought that we weren't talking about interest rates anymore. I said we are done with that. Not forever, but at least last week we had the big FOMC meeting. Obviously, Fed funds rates were decreased by 25 basis points. Talk of further rate cuts throughout the year. And as we see here, as I pull up SOFR, 30-day average of SOFR, it has dropped from, again, when we were back in September 2024, it was all the way up at 535. We had several rate cuts. SOFR is, pretty directly tied to Fed funds rate. We slid down eventually getting to, by January of this year, basically it was 432. And then we're getting ready to come down another 25 basis points. Looks like it hasn't filtered in through this chart. That's certainly a relief to some borrowers' floating rate debt. But more than that, I think there was hope that it would be an inflection point, that things would start moving in terms of interest rates into a more accommodative light, in that the Federal Reserve was going to be much more accommodative rather than restrictive. Because the fact is, the concern, and we're looking at a map of employment or unemployment in the United States. The chief concern here is a slowing labor market is outweighing the concerns of rising inflation. And if you're a listener of the Gray Report, or you're digging into this stuff all the time, you know that if you take shelter, real estate, specifically shelter, out of CPI, which is the main kind of inflation gauge that we use. If you take shelter out, inflation is basically at 2%, which is the Fed's target. And the way that shelter, especially the owner's equivalent of rent, is calculated in CPI, it doesn't really make sense. It's a lagging indicator, especially when we look at private data sources. We know that rents have been flat and negative across the nation on average. However, in CPI, it has never shown to be negative. So we've seen, not only positive CPI growth, but specifically for shelter, which makes up 30% of the overall weighting on CPI. So if you're nuanced enough and you can see through the headlines, you could start to come to the conclusion that, well, maybe inflation isn't as concerning as we were all thinking. Obviously, there's tariffs that are, hanging out there. But the conclusion from the Federal Reserve and the FOMC seems to be that, look, when that price spike from tariffs does filter into the data, let's look at it for what it is, which is most likely going to be a one-time price hike. Unfortunately, the amount of uncertainty that tariffs have portrayed, have embedded themselves throughout not just the economy but society, is leading to a inability from business leaders and individuals to make big decisions. And again, this it fascinates me that the idea of tariffs or monetary policy, interest rates, inflation, which impacts everybody, but can be relatively heady topics. You're not always hearing everyone always talk about, I am, but that's kind of what I do every day. Not everyone at the hair salon or the barbershop or the coffee shop are talking about inflation every single day, or monetary policy, or the Federal Reserve. And maybe I'm wrong, and maybe everyone is, but I'm assuming that the conversations I'm overhearing, that's not what everyone's talking about. Nevertheless, everyone, or most people, are unsure about where the economy is going to be. I'm asked all the time, every day, where do you think interest rates, Spencer, where will interest rates be next year? Where do you think the market's going? I'm by default an optimist. So I'm going to paint a relatively positive picture. And it's not because I'm talking my own book. It's mostly through observation over time that we hyper-focus on the worst case scenarios, when often the desire in the psychology in the invisible hand of the economy often tries to find solutions. And it's not always as bad as it seems. Not that there can't be black swans, not that things can't get really bad, and not that you don't observe trends to see where you might run into danger. But generally, people are always calling for World War III. It's a civil war. We're going to see hyperinflation. I'm somebody that's like who believes that we have problems that we need to fix in society, but it doesn't mean society's going to crumble tomorrow. So generally, I am an optimist, but I can't predict the future, and no one can predict the future. So business owners, when it comes to hiring for growth, you have to understand what growth may look like. And if you're in an environment where you don't know what your cost of goods because of tariffs, you don't know if we're going to find ourselves in a recession over the next couple of months, you may not make that hire. You might not make that purchase. You might not make those plans or start to execute those plans because you want to wait and see. Not only are business owners coming to that conclusion, but individuals are. And we're seeing it in the apartment industry. We're seeing very slow lease traffic, not regardless of the addition of new supply. I think all the new supply is making a more competitive market. There's a lot of slack in the system. But that doesn't explain everything, because it's not as though all of the new traffic, new individuals who are looking to rent a new apartment, it's not like that's staying constant and our renewals are at the same rate. So when we look at renewals, people are staying at our apartments longer than they have in the past. And this is a very new phenomenon. Instead of seeing renewal or retention rates, which is how often somebody stays at a property, on average of 50%, which is the industry average, and shockingly often is the case that your retention renewals are right at 50%, plus or minus maybe 5%. But now it's very common this year. Really started seeing at the beginning of the year, renewal rates in the 60%, 70%, 75%. And it's regardless of market and the new supply that was coming on in that market. And to me, that's direct evidence that it's uncertainty that is driving that lack of decision-making ability. And then that lack of decision-making ability, coming back to business owners, is leading to a lack of hiring. So the concern has shifted from inflation, which again, just talking about CPI, may not actually be the concern, and it's on to the labor market. And the labor market and the economy desperately needs some certainty.